The economy is, fueled by the real estate market, right? The housing market, pushes the economy up, pushes it down.
Owners are going to have to make that decision based on what happens with the tightening standards during the new refinance applications that are going to come through.
You're going to continue to see people leave cities, especially now that there's a more commonality of people working from home.
Hello everyone, Frank Rizzo with the MHP Exchange. Joining me is my actually voted the most refined person in the manufactured housing industry, Eric Busuttil. How you doing today, Eric?
Great, Frank.
What we're going to do, we're coming to the end of the year, and we're looking at our top 5 predictions for the real estate market in 2024. So we're looking at, this has been a crazy year. We've seen a lot of things happen. We've seen a lot of things not happen. I mean, there's been a number of transactions that just didn't happen. Transactions fell off the cliff because interest rates rose. But we want to look at what our top 5 predictions are for 2024 and how that can help you with your planning as you go forward. So, Eric, I'll let you start it off. What do you think is your top 5 real estate predictions in 2024?
The big topic has been interest rates, right, over the last few years in real estate, and how that's been affecting the real estate market. And, my biggest, one of my top predictions for this coming year, for a multitude of reasons, is you're going to see a slip in interest rates. And we've started to see that already for 2 reasons. I've been in mortgages for, over 20 years now. Typically, around the end of the year, going into the holiday season, you always see some sort of a dip. Right. More importantly, and why I see the rates continue to come down is also historically is election season. Right. So, the economy is, fueled by the real estate market. Right. The housing market, pushes the economy up, pushes it down. It's been somewhat stagnant for the last year and a half due to interest rates, and going into election season to stir the economy. You're going to see these rates, continue to dip a little bit. Just to kind of give you an idea of where I predict those interest rates to kind of stick around. I think you're going to probably see them bottom out in the mid to high 6s.
So that's an interesting point, because my top issue for 2024 is inflation. So I do not think that inflation has been under control. I think inflation is still out there. It's not as bad as might have been, 18 months ago, but pricing across the board for a number has an issue for consumers straight across the board. And the interesting fact is, if they continue to cut interest rates, I think inflation rears its head as bad as it was 24 months ago, which will affect affordability. So if they go the opposite way and continue to fight inflation, which, by raising interest rates, which you're right, historically, election years, they don't do that. But if they do that, then interest rates may have to rise. So I think it's an interesting thing that you have interest rates. I have inflation as number 1. I don't think that we've won the war on inflation yet. I think it's very evident. All you have to do is go to the supermarket, and I think that's creating pressure straight across the board. So interesting on number 1's back and forth, kind of related, but a little different. What do you have for number 2?
Number 2 for me, coming off interest rates, you're going to see a mini refi boom, right? And I think applications are already up. If you and I know our main premise of topics is always commercial, but you're going to see the residential market and the refi boom of the residential market put some money back into people's pockets and allow them to continue to invest in commercial real estate and residential real estate. But if you purchased a home, a 1 to 4 family home, whether it was a primary or a 4 family, you had interest rates over the last year and a half in the high 7s to low 8s for a certain period of time. And, if rates are in the high 6s, 1% interest rate decrease is, a decent amount of savings, and you're going to see people, get out there and refinance.
I don't know how much.
Another reason, Frank, realize, I mean, the cycle for most homeowners or property owners is, over the past 10 years where we had this low interest rate environment, is you buy a home, value of your home went up. Over the course of a few years after buying a home or a property, you'd run up a lot of credit card debt, or you'd refinance at some point in time. And people haven't been refinancing, but they have continued to run up their credit card debt, and the equity has not come down, right? But now people are going to be more willing to exchange that low interest rate that they have on their homes to pay off some of their debt, now that interest rate is 1 to 1.25% lower than it's been for the last couple of years.
I think you're going to see more applications in. I don't know how much, and it will definitely increase the amount of refinances that there are currently. The challenge I have, I think bank lending standards is going to tighten up, and I think we've already started to see that. That's
definitely happening already.
So I think while people are going to look to refinance, I think they're going to find that it's a lot more difficult than it was.
You're correct.
3 or 4 years ago. I think on the commercial side of it, I think what's going to end up happening, because they've initially seen a dip, there's $1.4 trillion that needs to be refinanced in commercial real estate. You're going to see an influx of applications that happen now. The people who can get financing will. The people who can't are going to have to make a decision and pivot, and probably have to have an exit on whatever asset they have, which is going to further depress commercial real estate prices going into 2024. So I think it's going to open up opportunity, an avenue of opportunity for opportunistic investors. And I think owners are going to have to make that decision based on what happens with the tightening standards during the new refinance applications that are going to come through.
Frank, on the commercial front, we have upwards of $1 trillion in term loans coming due over the next, few years, and you're going to see values come down, in my opinion, because if you purchased commercial real estate over the last 5 to 7 years, because interest rates were so low, people took max leverage, right? And the income approach values for these commercial properties when they purchase these properties, they're derived based on cash flow. So low interest rates, higher cash flow, higher values. People purchase with high leverage, low interest rates. When these notes become due, and you're someone who put the minimal down, and to refinance now at a higher interest rate, right? Having less cash flow, it's going to bring those values down. There's going to be a good amount of commercial property owners that are either A, going to have to bring money to the table to lower their loan amount in order to secure longer term financing going forward, or if they don't have that money, they're going to need to do what? Sell their property. And the problem that they have on refinancing is going to be the same problem that the new potential buyers are going to have to buy that property. So if they want to get rid of that property and they don't have the money to bring that loan amount down, they're going to have to sell at a lower price. So you're going to see lower prices across the board on the commercial front.
So we agree on that. That's great.
Finally.
We
agree on something.
Kind of. Not exactly, but almost.
Almost.
Number 3.
That was number 3, Frank.
That was number 2.
No, number 2.
We don't even agree what number.
Number 2 was a mini refi boom. Number 3 was decreased prices in commercial.
So my third.
Once again, I'm right.
No, that was your number 3. Wasn't my number 3.
Okay.
So I do believe that we're going to see, while we see affordability being an issue still because of inflation, and that is going to lead to, in certain markets, in certain bigger markets, I think a compression of rental value, of rental amounts. I think you're going to see, because there was such an oversupply in multifamily that was built over the last few years. Not every apartment is a $2,000 2-bedroom apartment. Not every market can support that. I think you're going to see some multifamily rents compress. I think that is going to lead to better values. People are going to find better values in secondary and tertiary markets. So I think you have to be cautious if you're going into an investment, you're looking at an area or you're looking at a property. If that property had seen double-digit rent growth for 2, 3, 4 years in a row, I think you've got to look at those rent prices stabilizing and maybe even contracting a little bit, and you better have that in your underwriting model. I think that's super important.
That's a great point, Frank. My number 4, you're going to see continued migration of individuals out of big cities, right? I think you're going to see a lot of that in real estate, and I think my last 2 is one to speak a little bit more about residential. We've seen people migrating out of these big cities for the last few years. Started with COVID. People wanted to get out of the big cities, but now it just the prices of these homes in these big cities, and for other reasons as well in these big cities, you're going to continue to see people leave cities, especially now that there's a more commonality of people working from home. Why am I going to stay in this big city? They're gonna go to other markets.
I think that now you agreed with me when I said secondary and tertiary markets will outperform, but that's okay. You can agree with me every once in a while. I happen to think because of that, what you see in certain locations, you have vacant retail, because retail has definitely changed over the last few years because of e-commerce and people more comfortable buying, not going into the store, right? And they're buying more online. And vacant office space, to your earlier point. So you have an affordability issue, which is driven by lack of inventory, and you have vacant retail and office space, and you're going to start to see a lot of that space being repurposed for different models, different hybrid models, or repurposed into housing. And we've already seen some municipalities kind of move forward with that, with a push to convert office space to housing, to convert old malls that have been left dormant and vacant to some mixed-use hybrid model. I think that's going to be something that's going to pick up a little bit of steam in 2024, and something to pay attention to, because that's going to change complexity. It's going to add inventory in areas where there might not be inventory, which will further maybe help prices come down a little bit on the rental front. And there'll be kind of a reimagining of some of these vacant buildings that we have across the landscape.
My final is you're going to see continued growth in investments outside of big cities, right? The cash flow, the numbers really, we're from New York. When you're from New York, you have family, you own real estate in New York somehow, some way, by accident. And we've been traveling, throughout the Southeast for the last, coming up on 10 years, and we've seen tremendous growth in these markets, particularly because, obviously, just the numbers make a lot more sense out of these big cities, and I think you're going to continue to see that. I think it's more apparent to the individual now, and people didn't want to invest from a distance. But I think, in being in these bigger cities, it's hard to make the numbers work unless you have a ton of money already and you want to park it somewhere. It's very difficult to make numbers work, especially now because of these higher interest rates. It's even more hard. It's even harder to make these numbers work. And I think, people feel a little bit better about having to travel for their investments as well.
Sure. And one thing that I think we haven't really discussed too much, but something that I think everybody should be made aware of. I think when you're talking about all these loans that have to be refinanced, right? And a lot of that commercial real estate is sitting in regional banks that is the vast majority of holding that paper. When those loans don't get recast or they become bad on their books, I think we're going to see more bank failures in 2024 than we saw in 2023. I think that's something that everybody should be careful of. I think for many years we kind of took it for granted that wherever we banked, they're there. It's going to be okay and not to worry about it. I do think that we should be more diligent about where we bank and why we bank, because, used to be a bank run was, you had to go to the bank and you had to get a check, and the bank could orderly, give out money that they had on hand. Now, as we saw in the last year, you can have a bank run in minutes where $50 billion left, Signature Bank in minutes because everyone's online. So you have to make sure, right, if you should look at where you bank and be careful where you bank, and you should diversify your banking. You shouldn't put all your eggs in one basket. I think that's super key if you're investing right now. Know who your banking partner is and watch what they're doing, because I do think 2024, you're going to see some more bank failures that could shake and rattle the markets a little bit. Those are our top 5.
And Frank, on that point,
you don't get 6.
It's not 6,
okay.
but safest place to keep your money is in real estate.
Absolutely correct. Safest place, because at the end of the day, it's a real asset. So that's our top 5 predictions for 2024. We look forward to seeing how the year unfolds. Come back to us next time. We're going to have top 5 predictions for the mobile home park industry. This is Frank Rizzo. That's Eric Busuttil, Mr. Refinement. We're from the Mobile Home Park Exchange. Talk with you soon.